Most investors are currently positioning their portfolios based on a dangerous rear-view mirror strategy. They are looking at the easy wins of 2024, seeing green across the board, and simply hitting repeat. That is a fundamental mistake that could cost you a decade of lost compounding. The market is currently pricing in a perfect soft landing scenario. It assumes inflation vanishes, growth continues, and everyone stays employed. But if you look deeper at the economic data, the signals for 2026 point toward a massive structural pivot. We are staring down the barrel of a K-shaped recovery, where the gap between the winners and the losers widens violently. If you are holding the standard 60/40 portfolio, or worse, blindly buying the S&P 500 at all-time highs without a strategy, you are walking into a volatility trap. I have identified a specific 3-fund ETF portfolio designed not just to survive, but to exploit the turbulence of the next 2 years. It uses a precise 60-25-15 split. This is not a random selection of tickers I found on Reddit. This allocation is engineered to capture the next wave of AI growth, protect your downside against a recession, and leverage a massive valuation gap that hasn't been seen since the late 1990s. This analysis isn't based on YouTube hype, influencer marketing, or looking at which stocks went up yesterday. To build this list, I used a rigorous macro-first approach. I spent over 100 hours dissecting the 2026 economic outlooks from premier global institutions like Morgan Stanley, JP Morgan, and BlackRock. Most people pick stocks and hope the economy cooperates. We did the opposite. We identified the environment first, specifically a falling rate cycle combined with sector-specific volatility, and then found the specific tools required to navigate it. In this video, I'm going to give you the 3 tickers, the exact tax strategy for where to hold them, so the IRS doesn't become the biggest beneficiary of your gains, and the reinvestment compounder method that makes this work even if the market stays flat for 5 years. This is the most thoroughly researched portfolio strategy I have ever posted on this channel. So please hit the like button and subscribe if you enjoy content like this and want to see more deep dives. Now, let's build the portfolio. The defensive foundation, 60% allocation. We are going to build this using the Barbell Strategy, and we start with the heavy lifter. This constitutes the defensive foundation and makes up 60% of the pie chart. Here is the reality check that most new investors ignore. We are entering a period where valuations are historically stretched. The price-to-earnings ratios of the S&P 500 are sitting at levels that typically precede lower future returns. When valuations compress, stock prices can stagnate for years. We call this a lost decade. It happened in the 1970s. It happened from 2000 to 2010. In those periods, the index price went nowhere. If you were relying purely on selling shares to live, you went broke. From 1930 to 2024, a period covering nearly a century of market history, 40% of the S&P 500's total return did not come from stock prices going up. It came from dividends. If you remove dividends from the equation, the history of the stock market looks drastically different. We are preparing for a scenario where growth slows down. If the market trades flat in 2026, you cannot rely on price appreciation to grow your wealth. You need a reinvestment compounder. You need an asset that pays you cold, hard cash just for holding it. This allows you to take that cash and buy more shares while everyone else is panicking. However, you have to be extremely careful. The world of dividend investing is a minefield. Most dividend ETFs are absolute trash. They fall into what we call yield traps. These funds buy companies that have high yields, but the yield is only high because the stock price is crashing and the business is dying. You do not want to own a dying legacy media company or a failing telecom giant just for a 4% dividend. That is how you lose money safely. We need a filter that ignores marketing names and looks strictly at math. Specifically, we need a fund that screens for cash flow to debt. Think about it. In a high-rate environment, or even a normalizing rate environment, companies with heavy debt loads get crushed. Their interest payments eat up all their profits. We want companies that are cash flow machines, businesses that print money regardless of what the Federal Reserve does. This is also where we deploy the DRIP strategy. DRIP stands for Dividend Reinvestment Plan. You must go into your brokerage settings, whether you use Fidelity, Vanguard, or Robinhood, and automate this. This ensures that when the market dips in 2026, your dividends automatically buy more shares at cheaper prices. This is turbocharged dollar cost averaging without you lifting a finger. It turns market volatility from an enemy into your friend. So, which ETF passes the institutional grade screen for cash flow, has a microscopic expense ratio of 0.06%, and is poised to explode during the 2026 deregulation wave? The ticker is SCHD. This is the Schwab US Dividend Equity ETF. It is the gold standard for a reason. It doesn't just chase yield, it chases quality. It focuses on companies with a minimum 10-year history of paying dividends, ensuring we avoid the flash-in-the-pan traps. It rebalances quarterly, ruthlessly cutting companies that start to show weakness. But there is a catch, a big one. You need to understand asset location. SCHD yields roughly 3.8%. While these are qualified dividends, which are taxed at a lower rate than your salary, that high yield creates a tax drag in a standard brokerage account. Every time you get paid a dividend, you trigger a taxable event. If you are reinvesting those dividends, you never see the cash, but you still owe the IRS. This slows down your compounding snowball. If you are in a high tax bracket, or if you live in a high tax state like California or New York, you should prioritize holding SCHD in a tax-advantaged account, like a Roth IRA or a traditional 401k. This allows you to compound that 3.8% yield completely tax-free. The growth engine, 25% allocation. Now that our defense is set, we need to go on offense. We need to allocate 25% to pure growth. But we have a problem in the current market called the Magnificent Seven divergence. We are watching a macroeconomic scenario play out called AI lift and economic drift. This means that a handful of companies like Nvidia, Microsoft, and Amazon are seeing massive growth due to artificial intelligence spending, while the rest of the economy is drifting or slowing down. These companies are currently spending billions on CapEx, capital expenditures, to build out AI infrastructure. If that spending slows down without massive revenue gains, the broad market could suffer. However, you cannot bet against this trend completely. You need exposure to these tech giants because they are the only ones with cash piles big enough to survive a recession and thrive on the other side. They are the new utilities of the modern economy. The mistake investors make here is buying the NASDAQ 100 or a generic tech innovation fund that charges a 0.8% fee. Let me explain why fees matter more than you think. Over a 30-year horizon, a 1% fee can eat up to 1/3 of your potential compounding. That is the difference between retiring at 60 and retiring at 70. Minimizing fees is the only guaranteed way to increase net returns. We need a fund that costs almost nothing, 0.4%, and rarely distributes capital gains, making it extremely tax efficient. Unlike our first pick, this ETF is a capital appreciation play. It doesn't pay a big dividend, it grows in price. That means you want to hold this in your Roth IRA if possible to avoid taxes on the huge gains, but it is also perfectly fine in your taxable brokerage account. Because it pays very little in dividends, it creates very little taxable income year to year, so the tax drag is minimal. It captures the top growth stocks in the US, but unlike the NASDAQ 100, it filters for stronger fundamentals and broader exposure, so you aren't just betting on one single sector. The ticker is SCHG. This is the Schwab US Large Cap Growth ETF. It gives you the exposure to the Magnificent Seven that you need, but at a fraction of the cost of other funds. But here is the warning for this slice of the pie. You cannot just set and forget this blindly if the economy turns. You must watch the earnings reports of the top holdings in SCHG. Specifically, look at the return on invested capital for their AI spending. If AI revenue starts to crack in late 2025, or if the market decides AI is a bubble, SCHG will take a hit. In that specific scenario, rebalancing out of SCHG and into our defensive position, SCHD becomes the necessary defensive move. This is the active monitoring required of the barbell strategy. The explosive bet, 15% allocation. Now we move to the final slice, the final 15%. This is the rocket fuel. If the first fund was for safety and the second was for growth, this third fund is for deep value. Right now, the market absolutely hates this asset class. It has underperformed large cap stocks for years. The narrative is that these companies are dead money, but that is exactly why we are buying it. The markets are pricing in 2026 rate cuts now. When the Federal Reserve cuts interest rates, it helps one specific group of companies more than anyone else: small caps. Small companies often rely on floating rate debt. When interest rates went up in 2023 and 2024, these companies got crushed because their interest payments skyrocketed. It suffocated their earnings. But as rates come down in 2026, their expenses will drop specifically, causing their profit margins to expand instantly. This is the macro tailwind we are betting on. This relies on the waiting game psychology. This asset class can do absolutely nothing for 3 years, frustrating you, making you want to sell, and then explode upward to deliver a decade of returns in a single 12-month period. You have to be in it to catch that move. If you miss the 10 best days of the market, your returns get cut in half. However, and this is crucial, you cannot just buy a generic index fund like the Russell 2000 here. The Russell 2000 is a broken index. It is filled with what we call zombie companies, companies that don't earn enough profit to pay the interest on their debts. Nearly 40% of the Russell 2000 is unprofitable. If you buy the index, you are buying the garbage along with the gold. Academic research from Fama and French, the fathers of modern finance, proves that for this specific sector, you must screen for profitability. If you buy the junk companies in a recession, you will go to zero. You need a fund that applies a rigorous filter to remove companies that are losing money. This trade requires a 3 to 5 year time horizon. Do not sell this if it lags SCHG for 2 quarters. The payout is structural, not tactical. We are buying this for the 2026 rate cut cycle. The ticker is AVUV. This is the Avanti's US Small Cap Value ETF. It is actively managed but follows a rules-based methodology to capture the value premium and the size premium while filtering out the junk. It is the sniper rifle approach to small caps, whereas the Russell 2000 is a shotgun. So there is the allocation: 60% SCHD for income, defense, and compounding dividends, 25% SCHG to capture the AI-driven growth of the mega caps, and 15% AVUV for the explosive small cap recovery when rates fall. This portfolio gives you a weighted average expense ratio that is incredibly low, massive diversification across sectors, and a strategy that works whether the economy booms or busts. You have the defense to sleep well at night, and the offense to actually grow your net worth. Now you have the perfect portfolio to navigate the turbulence of 2026. You know the tickers, you know the allocation, and you know the tax strategy. But knowing what to buy is only half the battle. The much bigger and frankly more terrifying question is, how much money do you actually need in these funds to quit your job and live off the passive income? Is it 1 million, 2 million, 5 million? Most people overestimate the number by millions and end up working 10 years longer than they have to, enslaved by a math error. I've broken down the exact math on the absolute lowest amount you need to live solely off the Vanguard S&P 500 and these types of ETFs. It is likely lower than you think. You can watch that breakdown right here. Click it, and I'll see you there.